Discuss Christmas in September. Really, Michelle?
Yeah, it's not obviously quite Christmas in September, but the idea is that we are seeing evidence that consumers are spending earlier this holiday season. And when you look holistically at the aggregated Bank of America card data, September showed some real momentum. And part of that is this broadening of spend across goods, and particularly in areas like clothing and electronics, things that are most sensitive to holiday sales, which could be a function of this pull forward of holiday spending. But you're also seeing this kind of mini re-engagement on the leisure side too, which has been super encouraging. So the card data we've been following has been really quite positive for the consumer and making me feel pretty encouraged as we head into the next quarter.
Yeah, but everybody knows we're just pulling forward from December 23rd when I begin my shopping. Great. Have you adjusted your GDP view? Our theme today on September 30, no visibility Q4, no visibility Q1. Give us some visibility.
Yeah, well, I think we're seeing just that with our high frequency data, that we're setting up what should be a better Q4. So Q3 GDP is coming in right around 4%, give or take a few tenths here. But Q4, it looks like our baseline forecast has been for 6% growth. And I'm holding to that number. And the data that we're tracking, the high frequency data that's inflecting higher, suggests we could very much succeed on that forecast for 6%. So I think the demand is there. The indications are that we're seeing this re-engagement in the economy start, which is really encouraging as COVID cases come down. The real question will be on the supply side. How much capacity is there to realize the strength that we're now seeing on demand?
And the flip side of that is higher prices, which we're seeing in a whole range of places, right? And I'm wondering, the sort of stickiness here that we're looking at going forward, and the disinflationary kind of trend that people were talking about before, when people are spending more for the same amount of stuff. What's your view on how that's affecting consumer sentiment and their willingness to spend?
Yeah, I mean, that's exactly right. There's all this demand out there and there's limited supplies. And unfortunately, the supply chain issues have gotten worse, not better. So that's a real concern. And what that means is that there will be, higher prices. They're already seeing it and they will continue. And if people are buying early in the holiday season, it means that you probably don't have the same level of discounting that you've had in prior holiday seasons, especially in an environment with low inventories. So what does that mean? Well, consumers are taking notice. Right. Look at the University of Michigan survey. People are more discouraged because prices are high and they can't get some of the items that they're looking to purchase. So when you consider adding up for GDP, you're looking at in real terms, inflation adjusted terms. So you could get this bigger divide where nominal really, accelerates into the fourth quarter, but real GDP maybe struggles a bit more. So that's something that we're keeping an eye out for when we think about these supply constraints.
Your specialty is the housing market. That's where you made your name. And we're watching the housing market actually embody this inflationary push, possibly more than any other. The idea of 20% year over year gains month after month after month. How does this factor into discretionary spending, to inflation more broadly, at a time when Jay Powell says that a lot of this is just transitory and supply chain related?
Well, look, I think housing is a perfect case study of this imbalance between demand and supply in the market, where demand has just, climbed higher in the housing market in a very constrained environment. Now, builders are responding. That's good. Inventory is picking up. Look at the new home sales report. The month supply figure there is now touching around 6 months. So that's quite good. We're making progress, but we're not at a point yet where home prices are starting to cool. We're not at a point yet where you've kind of lost some of the frenzy in the market. It's still there when you look at the number of days in the market for sale for these homes. Things are moving quickly. There's also a lot more cash buyers. There's a lot more investors in the market.
Yeah.
So what does this mean broadly? Well, it does fuel this kind of inflation sentiment. It's one of the factors that you want to think about when you're considering inflation expectations and how people perceive the inflationary environment. But then also just more on a nuanced view, right? It does ultimately impact the rental market, which ultimately impacts owner's equivalent rent. And that's starting to show through very, very clearly in the high frequency data. So we should anticipate that owner's equivalent rent moves up into next year, even if some of these more transitory factors that have been boosting inflation wane.
That's great to hear. Michelle Meyer in her wheelhouse when we first met her a zillion years ago out of BU. Michelle, I want to talk here about transitory, and it's what everybody's talking about in these two Americas, and one of them is an America flat on its back. Is a negative real wage here to stay, or is a negative real wage transitory?
Well, right now it's particularly painful on a year-over-year basis because you've seen these extraordinary gains in inflation. But when you look forward, I think the wage environment is quite positive, particularly for the lower income consumer that's going to be a lot more sensitive to moves in inflation. So I think, given the incredible demand for workers that we've been seeing, particularly in the lower income part of the population, wages have been rising, and I would expect that to continue. Now, of course, yes, you have to consider the pace of wage increases relative to the pace of underlying inflation to back out that real wage number. And right now it is a bit more problematic, but I think into next year you get some cooling in some of these components where inflation has just been extraordinarily high, and meanwhile wages continue to creep up. And I think that's a favorable backdrop.
I look where I look where we are, Michelle, and I've got to interrupt the train of thought here. When we see yen go out through 112 onto 113, dovetail Bank of America foreign exchange analysis into your great American economic view. How does strong dollar change your calculus?
Well, look, I mean, the strong dollar presumably is a function of the fact that it's a strong economy. So I would argue that the dollar strength that we've seen has not been unwarranted or unsupported by the fundamentals in the U.S. economy. But yes, of course, when you think about the FX moves, you think about the balance of trade, you think about the cost of goods, and all of those things are obviously going to be impacted negatively when you have a strengthening in the dollar. But I would argue, and very much with our FX strategists believe, that the move in the dollar is justified given what you're seeing in the U.S. economy.
So before we let you go, Michelle, we've heard a lot of Fed speak over the past couple of days. It will continue today. Fed Chair Jay Powell on the Hill. Is there anything that he has said over the past couple of sessions that we've heard from him that's been of interest?
So, you kind of always have to read between the lines. And I think that there's been a real emphasis on the supply side of the economy. Because it seems like there's this discussion within the Fed over whether or not all this demand side policy, very accommodative monetary policy that stimulates the demand side, is the right prescription if you're really facing a bigger supply side shock. So they're trying to figure out how permanent the supply side issues are. And one of the ways to gauge that, frankly, is just to go back to inflation, what you talked about before, Lisa, particularly long-run inflation expectations. The extent to which long-run inflation expectations move up will tell the Fed that they have a more permanent constraint on the supply side, and that will prompt them to pivot when it comes to dovish monetary policy. They're not seeing it yet, but they're obviously very, very, very keen to focus on this topic and looking at it very carefully, which makes a lot of sense.